Hello and welcome to Market Domination. I'm Josh Lipton alongside Akiko Fujita, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed on the hour, or speed 1 hour before the closing bell rings on Wall Street.
More than likely, we'll get like a little push into the end of the year, right? But I think we're right here at the top. I think where we are 6,000, the mid 6,000s, like 6,050-ish, is probably where we're going to end up, right, as we move in. It's been a great year, right? You can't really complain about the stock performance of the year. But look, as we move into the next 4 days and then next week into Friday when it ends, that Santa Claus rally period, it's going to really set the tone for a lot of people, right? Typically when we see that Santa Claus rally advance going into the first week of January, that sets the tone for the new year.
The thing that I'm watching the most closely is if the SEC decides to pull back on some of the lawsuits it's brought against big crypto companies, you know, most particularly Coinbase. Actually, Coinbase sued the SEC and SEC has sued Coinbase. So if they cut deals around some of those cases and just sort of knock them out of the running, then I think that would be a thing that the new SEC commissioner could do, the new SEC commission could do really fast, and I think that would have a big impact. So that's the first thing I'm watching.
I think this was a great home run for the ad business that they have. I think it's really going to bolster their ad tier. And overall, I think it's going to pull in. It's all about scale. It's all about monetization. And I think this one was a hit in every which way.
We've got 1 hour to go until the market close. And taking a look at the major indices, a bit of a sleepy or thin trading day, you could say, coming back from the Christmas holiday. All three major indices seeing green right now, but we are talking about pretty flat trading here. We did get at least one data point today on the unemployment benefits, recurring applications for those unemployment benefits rising to the highest in more than 3 years as well.
Yeah, it's a bit of a quiet session, Akiko, maybe muted is how some might put it. You know, and not unexpected, of course. We're sitting here between Christmas and the New Year, but volume is thin. I actually saw Bloomberg point out, if you look at volume on just the SPX, the S&P 500, we actually are about 45% below the average of the past month. So a lot of folks still on vacation. Yeah,
some stocks still moving. Two that we can point to specifically here. Apple and Tapestry hitting new 52-week highs. Let's talk about Apple, shall we, Dan Ives? Upgrading the stock again here. 12-month price target to $325 on Apple. That is the new high on Wall Street. Taking a look at where it is right now, slight pop there, 259.25 is what we're looking at.
Almost, you're kind of knocking that $4 trillion market cap.
Also taking a look at Honda, I know this is the stock that you guys have been talking about all week here on the back of those merger talks with Nissan. Honda now on track for its best week in 16 years.
Wow, that's a nice stretch. Look at that chart. There you go. All right. Well, you know, I bet some viewers might be thinking, Akiko, what do the charts tell us, though? What do the technicals have to say? And I have just the man for you. For more on the latest market moves, let's welcome in Craig Johnson now. He is Piper Sandler's Managing Director and Chief Market Technician. Craig, it is always great to see you and have you on the show. I was talking to Akiko there, a bit of a quiet session, not surprising, of course. But let's start high level here, Craig. You know, you look at the S&P 500, you look at the charts, Craig. What do the technicals tell us about what could be coming next?
Thanks, Josh. Kiko, thanks for having me on, and I hope you guys had a great holidays. What the charts are telling us right now is still the trend. If we look at all the broader averages are still higher. There's lots of conversation among all the institutional accounts that we talk to on a regular basis that are concerned about how far this market has run in 2024. And they're sort of nervous at this point in time as we've been sort of pushing along the upper end of the price channel on the S&P 500 pretty much for the last several months in here. From my perspective, I think as you look forward into 2025, it's going to be a pretty decent year. But I think you only got about kind of 9 to 10% upside in 2025, as typically the third year of bull markets are typically a little bit, shall I say, a little bit weaker than what you see in the first and second year, Josh. And that's typically only up about 5%. So from my perspective, the trend is still your friend for now. But at this point in time, expect to see some pullbacks, some volatility, and the speed of this advance to probably slow down a little bit as we move into 2025.
Yeah, so 9 to 10% upside, not the kind of gains that we saw this year. But as you look ahead to 2025 and seeing slower gains there, how do you position yourself?
Well, I think you're going to position ourselves a couple ways. But before we think about what sectors we should be in, we really got to address the big picture question of 10-year bond yields, right? Because that's going to be the biggest decision I think most investors are going to be making in 2025. And as you look at a chart of 10-year bond yields, from our perspective, very long term, you know that we have reversed a 40-year downtrend a couple years ago, back in 22. And what we're seeing here in a more shorter term time frame that investors are focused on is a series of sort of lower lows and lower highs. That is your basic definition of a downtrend. And at this point in time, we're testing the upper bounds of that downward trending price channel. From my perspective, I think when some of the quantitative tightening starts to ease in the first and second quarters of 25, I think we'll ultimately see 10-year bond yields retreat. And I suspect you can see them pull back as far as 3.5% as you get into 2025, which I do think will be positive for equities. But I think it's also going to be a question of how do investors interpret the message of 10-year bond yields coming down? Is it going to be bullish for equities, or is it going to mean that growth is ultimately slowing? And I think that is the single most important question that investors have to sort of get their arms around as they set their outlook for 2025.
Another potential headwind for the stock market, besides the benchmark 10-year, Craig, obviously the stronger dollar. I'm curious, as a technician, what do you see for the greenback?
Well, the greenback has just started to break out. And when we go through and we look at the chart on the dollar at this point in time, I would not be surprised to see another leg higher in here. When you look at a multi-year chart, Josh, you can see a big double bottom has been made. We've just started to take out some important support levels right around this kind of 107.28 level. And on this breakout here, we could potentially see it move as high as back toward about 109, 110 range, Josh, on this sort of breakout in here. I think the combination of a new administration coming in, the likelihood that there'll be some tariffs, maybe not as high as what people have originally thought, but definitely some tariffs, probably leads to a stronger dollar. But that stronger dollar is also going to lead to, we think, some headwinds for these multinational companies. And I know there's been a lot of discussion in Apple getting close to $4 trillion in market cap, but expect a lot of these big multinationals to probably experience some headwinds next year, which is probably what holds back equity markets to a degree in 2025.
Craig, let's expand on that a bit more. I'm looking at some of the sectors you're underweight on, basic materials, but also transportation, consumer staples. How much of that has to do with potential impact from Trump policy? How much of that is just sort of the underlying basics that you see within those sectors?
Well, I think a lot of it comes back to a very basic generic statement. And I would love to pay a penny to the person who originally, created this line. But it really comes down to that the U.S. innovates, China replicates, and Europe regulates. And when you think about where you really want to put your money, still the best place to put your money is here in the United States. And so if you look at the sectors we're over and underweight, a lot of that is going to be based upon our technical work that we do. And when you think about basic materials, you think about consumer staples, a lot of those sectors, and even transportation to a degree, they're making 5-year relative strength new lows in our work. And again, it's not just purely based upon the GICS classification, as Josh knows from calls and stuff we've done over the years, but it is based upon looking at 5,100 stocks in the marketplace. And as we do that analysis, there is just no sort of reprieve for those companies. But on the flip side, we are seeing 5-year relative strength new highs in financials. We're seeing 5-year relative strength new highs in services. Also continue to see an improvement in relative strength in the technology sector. And also the industrials still look good. The industrial sector could definitely be a beneficiary of those stronger sort of trade policies as more manufacturing shifts back to the United States.
Craig, you mentioned Apple. I just want to double click on that real quickly because it's higher today, Craig. It's being talked about because it's knocking right on that $4 trillion market cap. As a technician, when you look at the iPhone maker right now, Craig, what are the charts telling you?
Well, I come up with two conclusions for Apple. No question, it is one of the best, if not the best company in the world. And there's no question that the stock is trending higher. I got to put the however in here, though. When you compare it to the S&P 500 and you look at it on a weekly basis, on a relative basis, we're not making new highs. So a lot of these FANG-related stocks are still, at this point in time, sort of becoming bag 7 to lag 7, as the relative performance has not been nearly as strong. I would rather see investors, and I suspect this will happen as you get into early 2025, investors taking some, not all, but some of their profits out of those larger cap stocks, reducing those positions, and then again, recognizing some of those gains that they may not have wanted to recognize in 2024 and shift down cap. Looking at stocks like Twilio, looking at stocks like Robinhood on a more friendly crypto policy from the new administration. Those would be a couple areas that investors could definitely look at. And also, don't forget about the optical companies out there. A lot of these optical companies have not been on investors' radars for years. Stocks like Coherent is another one that looks quite constructive and trending very well in here. Could be a better place to put some money to work.
Craig, we haven't talked about small caps yet. What do the technicals tell you about how much upside there is there?
Well, if I go through and I look at a chart of, say, the Russell 2000, it is one of the few indexes that has not made a new all-time high at this point in time. I just note that when you go back to 1991, there has not been 3 consecutive years in a row that the Russell has not made a new all-time high, especially when you're seeing the S&P 500 making new highs. So again, I think that we will see the Russell make a new high. And if I had to guess, the Russell 2000 will likely outperform the S&P 500 in 2025 is my guess, because again, we're going to see some sort of catch-up period that's going to come into play for the Russell. And with the financials working, industrial starting to improve, the only thing that would be holding back the Russell index itself would be some of the healthcare stocks. And those, again, are quite weak and making relative strength new lows right now.
Craig, always great to see you and have you on the show. Thanks for taking the time. Appreciate it.
Anytime.
Coming up, why gas prices could reach their lowest level since 2021 next year. Stick around. Much more market domination still to come.
With markets in the final trading days of the year, we are looking at the year that was for energy, a sector caught in an era of transformation. Yahoo Finance's Inez Ferre joins us now with more. And it's not just transformation, but a sector caught in geopolitics.
Yes, for sure. And if we take a look at XLE, the S&P 500 Energy Select Sector, you can see that year to date, it's relatively flat, up just 0.5%. If we take a look at the chart, you're looking at that first quarter where it rose because of also geopolitical tensions. Energy prices were up, were higher. But then you had a lot of volatility when it came to that. The markets at the beginning of the year had thought that rate cuts this year would spur demand, but geopolitical conflicts sent the price of oil higher. But then we had a lot of volatility again when it comes to oil. And looking at our energy heat map, I just want to show you what some of the major leaders and the laggards were when it came to the energy space this year, because you do see a mixed picture. Pulling up a year-to-date chart, you'll look a lot of red here and also a lot of green. So there's been sort of a bifurcation happening in the energy market. Commodity traders have been watching what's happening to oil supply and demand. When it comes to crude, China is the biggest importer of oil, and that country has slowed its demand growth. OPEC is sitting on the sidelines with spare capacity, wanting to do away with production curbs. So for next year, Wall Street estimates vary, but analysts are saying that you're going to see the price of oil slightly lower, depending on which analyst that you listen to. But on the natural gas front, that story is a little different. And some of the green that we're seeing here on this chart are companies that deal with natural gas or infrastructure pipelines when it comes to natural gas. And I want to show you some of the big gainers that we're seeing when it comes to 2024. You're looking at those companies there, the Williams Companies, Natural Gas and Infrastructure, Kinder Morgan, Nat Gas Pipeline and Transportation, Oneok and Energy Infrastructure Company, and also you've got Texas Gulf, that's a construction services and manufacturing. So the industry is more bullish about natural gas because Europe wants to become more energy independent from Russia. So they're looking for more storage capabilities, importing from more LNG, and the U.S. is the country that is exporting so much LNG to Europe. So for next year, analysts are saying keep looking at natural gas processing and transportation companies, infrastructure, equipment, servicing companies. Those are expected to be some of the winners into 2025. Also, regulation, deregulation from the Trump administration, which the Trump administration has promised to deregulate the industry. And that usually tends to mean lower costs for companies, i.e. more profitability for those companies.
Okay, and as Ferre breaking it all down for us in the energy sector, thanks so much for that. Yeah. Well, oil edging lower on the day, breaking below $70 a barrel. While there were some volatile moments in the oil market this year, crude is down 2% for 2024. And our next guest says that's because oil has lost its mojo as a speculative bet or investment play. Joining us now is Tom Kloza. He's Opus Global Head of Energy Analysis. Tom, good to talk to you today. Let's start right there. That's what kind of stood out to me on your note, talking about how some of that lack of mojo within oil is capping some of the gains that we may have seen in the past. Walk me through your thinking there.
Sure. I think this is hiding in plain sight. If you look at oil and you look at the fascination people had with oil as an investment or a speculative vehicle, back during the ages of the Arab Spring, it was a great place to park money. It was a place that you would see a lot of speculative money go, but it really has lost its mojo. I mean, now that money, that hot money, that fast money, that huge money goes into crypto and it goes into big tech. And there are a lot of people, including many, many well thought about analysts, who are predicting that we're going to go back to the days where there's 10 buyers for every sellers on the speculative side. But I would submit that we may never go back to that. I mean, oil is something that is capped certainly 15 or 20 years from now in terms of demand, and it just doesn't have that same lure to the investing public as it had before.
So, Tom, I'm curious, bottom line, if Brent here is at 73 and change, what do you see over the next 12 months?
The three words to keep in mind are front-end loaded. The first 100 days of 2025 should be front-end loaded. There's enough uncertainty with Trump 2.0 and with possible tariffs and with increased pressure on Iran and Venezuela, probably send oil prices up a bit. But ultimately, OPEC, would like to put out a little bit more oil in April. We think they may actually keep the production cuts through the end of 2025. The world doesn't need the oil. And they have about 5.5 million barrels a day of spare capacity. So they've got a real problem. I mean, after we adjust to some of the uncertainty related to the Trump presidency, I think prices may come down, and there's a much larger risk next year of a big price drop, to $50 or $60 than there is to something in the 80 plus range. It would take something on the order of the Russian invasion of Ukraine or a wider Mideastern war to really send oil prices back up to those 22 and 23 highs.
So you're looking at $50 to $60 a barrel. I mean, is that based off of just demand that's out there or the lack of demand? Ultimately, that's going to bring some of those prices down?
I think demand's decent. I think demand will be up 5, 6, 7, 800,000 barrels a day. But we're coming out of a couple of years where it was up 1.2 and 1.3. And the other side is that, there's consideration perhaps that China has hit its peak gasoline demand. I saw some stories this morning that said that EV sales in China are going to surpass ICE vehicles very shortly. And it's pretty easy to implement EVs in China when you have an autocracy there. So, we're going to get some additional demand from India. The United States gets more drivers, but the vehicles are getting much more efficient. I do think we'll see a slowdown in EV adoption in the United States, but we used to use 9.3 million barrels a day of gasoline from 2016 to 19. Now we use about 8.8. And, kids don't get excited about getting that first car and driving all over the place and taking road trips like they used to. They like the teeny weeny world of different gadgets and stuff.
Tom, with Trump coming back in the office, we'll see how different policies shake out. But on the demand side, tariffs. On the supply side, Tom, it's perfectly possible Trump comes back in and really does slap new, tough sanctions on Iran. If that were to happen, Tom, what could that mean for the oil market?
Well, not too much, because Iran's principal customer for exports is China, and they're only exporting about 1.5 million barrels a day. I think the market is anticipating that there will be additional restraints on Iran and probably Venezuela. Venezuela has the greatest proved reserves in the world, but as long as they have the Maduro administration down there, they're not going to be able to tap that reserve. So I think those things are factored in, but we've got new oil from Guyana. We've got plenty of oil coming up in the Gulf of Mexico. You don't hear much about it. You hear about the Permian Basin, but there's probably 500,000 barrels a day of deep water or shallow water Gulf of Mexico oil that's coming on stream in the middle of this decade.
Yeah, Tom, can you speak on that a bit more? I mean, Guyana is a place we hear often from these oil companies. They see a huge reserve, there's a huge opportunity. As we sort of see not necessarily retreat, but as you said, more sanctions on Iran, on Venezuela. How are we seeing the landscape shifting, particularly in this sector?
Well, we may see it shift. I mean, we'll still probably see discipline in the Permian Basin where, I talk about the 7 and 7s, where it takes maybe 7 months to employ a rig and find some oil in shale, where it's maybe 7 years if you do it in the Gulf of Mexico or deep water Africa. So, you're not going to roll back those big projects. You're going to see oil come on from there. And in some cases, they have $20 or $40 break-even numbers. So that oil is coming on stream. It won't be killed by prices briefly below $60 a barrel. It's actually a pretty optimistic viewpoint going forward. I think oil is going to be profitable enough for smart companies and companies who monitor costs carefully to do well. But I don't think it's going to be the kind of thing that really adds to inflation like we saw in 2022 or 23.
Tom, always good to see you and have you on the show. Thanks for joining us.
Thanks, guys. Have a great new year.
You too. Now time for some of today's trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, let's take a look at Microsoft, as the company reportedly discussing potential changes to its partnership with OpenAI. This is according to the information to Kiko, which says they're wrangling over terms of their partnership. Microsoft, of course, has committed billions to Sam Altman's OpenAI. Sam Altman, we know, wants to convert into a for-profit corporation. So what are they wrangling over? Well, apparently, it comes out of 4 areas, again, per the information, citing a source familiar. The 4 areas are Microsoft's equity stake in the for-profit entity, whether Microsoft would continue to be OpenAI's exclusive cloud provider, that'd be a big one, how long Microsoft can maintain rights to use OpenAI's IP in its products as it pleases, and whether Microsoft will continue to take 20% of OpenAI's revenue. So lots of chat about between those two.
I mean, this is a fundamental change, right? That's happening within the company. It is a company that was built by nonprofit board of directors. That's what they have right now. That oversees a for-profit unit. So ultimately, that shift has to happen. The $13 billion Microsoft invested in was for a nonprofit structure. There's got to be some significant changes that happen that come out of that.
Yeah, I mean, Sam Altman really has his hands full in 2025. I mean, he has Elon Musk, co-founder of OpenAI, has sued to stop OpenAI from converting to a for-profit. And then there's kind of this broader discussion, which is so interesting, Akiko, about just when you look at sort of the marketplace for LLMs, these large language models. We've spoken to venture investors on the show who would say it was just Sam Altman's world, Really, there wasn't a close second, but we've spoken to folks who invest in the space who really argue that in the past 6 months, there's been a change, and you really see now rivals who also have smart engineers, who also have very deep pockets, closing that gap.
Yeah, more and more competition and regulation to come as well.
Absolutely.
Taking a look now at Cooler Technology, those shares soaring as the company launches its Bitcoin treasury with the purchase of roughly 217 Bitcoin. Ultimately, Josh, this comes to allocating up to 90% of its surplus cash to BTC. Kind of reminds me of another company here, right?
A certain Bitcoin guru, perhaps?
And this got me thinking. I was looking at MicroStrategy, of course, the other company we're talking about. They have gone all in on Bitcoin. Yes. Initial BTC purchase in August of 2020. You look at the chart, see how it's done. I mean, you look at a company like Cooler, they're probably seeing the success that they have seen. MicroStrategy has seen on the back of that. MicroStrategy cumulative investment of roughly $16.5 billion. So, Cooler is still very small when you compare it to that.
Yeah, for sure.
They maybe see a winning strategy there.
Yeah, and in fact, too, MicroStrategy did announce plans earlier this week. Just reading here a report from Bloomberg, they're going to expand Bitcoin buying program over there. It wants to increase the number of authorized shares of Class A common stock and preferred stock, which of course would mean more firepower for Mr. Saylor for those Bitcoin buys. All right, finally, let's take a look at the meme trade. And of course, there we have to talk about shares of GameStop, extending gains as a vague image post on X from Keith Gill, also, of course, known as Roaring Kitty, helps lift that stock today. So we did have a new X post, Akiko. I wish I could tell you more details, but it's Roaring Kitty.
All we got.
Keith Gill post that was December 25th. Image of some kind of gift. Make of that what you will. Bloomberg did note, listen, where trading volume spiked on it. No surprise.
We don't know what it symbolized. No. We don't know what's coming on the back end of it. And every time
ripped higher this year.
It has more than 70%, right? In this year. Ultimately, though, every time we talk about GameStop, I sort of have to be the person that brings it back to reality. Sales down year over year for 5 quarters.
Come on, look at the
Street
chart.
Expecting another decline in the next quarter. I mean, this is what it is. This is why we call it a meme stock. There's no fundamentals to be traded on here, but stay tuned. What do you think the gifting image means? What does it present mean?
I couldn't even begin to tell you. We have Noor Al from StockTwits on the show recently, who said to us, GameStop still front and center. Especially when Roaring Kitty posts, he says, still platform blows up. And they actually have, I didn't know this till Noor told me over there at StockTwits, they have the second largest GameStop community, 300,000 watchers there. Just watching
GameStop alive and well, the meme stock, we should
posts.
say, the alive and well. We'll find out for any additional clues here. Coming up on the other side, we are checking in on our top call of the day. As one analyst says, Palantir and Salesforce are leading the way for the software AI era of growth. Stick around, much more on Market Domination still to come. U.S. relations with China has been a focal point as President-elect Trump promises tariffs on Chinese goods. But our next guest is highlighting opportunities with India for the U.S. as a strategic and economic partner. Krishna Gupta is Remis Capital founder and CEO, joining us now for a closer look. Good to talk to you today. You know, it's interesting to me that India comes up as an opportunity in the face of China when you think about what the potential is for President-elect Trump's policies. I mean, if there is sort of a blanket tariff, then wouldn't India get caught up as well? I mean, what makes you optimistic about a potential catalyst coming from Trump 2.0?
Yeah, well, first of all, thanks for having me and great to be here. I think India, at the end of the day, there's two major differences with India versus China. Well, I would say three. One is, India is more aligned with the U.S.'s foreign policy. And so I think as the U.S. and as President-elect Trump looks forward over the next few years, he's going to look at India as an ally, and that's going to impact how much he wants to use tariffs to sort of impact that relationship. The second is, the sort of the balance of trade and economies is much more balanced when it comes to U.S. and India. And I think there's less of a concern when it comes to the average American worker, the American corporation, as to whether they can effectively do business with Indian enterprises back and forth. And in fact, I think most of them welcome the opening of these relationships and the flows of capital and talent between the two countries. Whereas with China, I think we have a very different situation where there's a perspective that, hey, our businesses in America are unable to do business on an equal footing in China, and that there's some kind of imbalance in the favor of China that needs to be rectified using tariffs. So that's the second. And the third is, the demographics of India and the stable governance of India put it in a class of one of one. There's no other country and economy that is as vibrant, as large, and as free to do business with as India is today from an American businessman's perspective. And so I think President Trump will look at all of those factors, and I have reason to believe that I don't think he's going to treat India in the same way he treats China.
It's interesting, Christian, this trend we've seen of American companies looking to diversify their supply chains, become less reliant on China, looking to India. But can India, Christian, in your opinion, can it ever actually really replicate what China was able to accomplish, really becoming just the manufacturer to the world over there?
Well, I think I would reframe that. I don't know that India necessarily desires to be the manufacturer of the world. I think, the answer to your question is I believe India can. The quality of manufacturing that I have seen over the last 10 years has improved dramatically. And that includes in everything from, hardware and electronics and whatnot, as well as I think even things that are, pharmaceuticals, the quality control, which was lacking in India 10 to 15 years ago, has changed dramatically. But I want to shift that back to, I think India wants to be increasingly an innovation economy. Not a manufacturing economy. And that's also partially why I come back to my comment earlier, which is the U.S. should not look at India as a threat where there's going to be cheap jobs and manufacturing that'll be outsourced. That is not India's goal. Now, India is an asset for companies like Apple and others that are looking to find effective offshoring. But that is not the vision of the Indian economy, even though it can fulfill that role.
So what does that ultimately mean if it's not just about manufacturing as it has been with China and it's about innovation? How do we see that manifest in the context of U.S.-India relations?
Well, I think it comes down to an open flow of capital and talent. And there's a vibrant debate going on right now, in fact, all over Twitter about the appointment of this new AI czar who is originally Indian and what that means for the American economy and the American innovation ecosystem. And from my perspective, it's as simple as the more flow there is of ideas and capital between the two countries, the better it is for both, because the size of the pie can be 100x from where it is today. So to be more tangible, for example, I have a company called Viome Holdings, which is a healthcare play, and the innovation comes from world-class researchers in India, but all the clinical work is done in the U.S. And the idea is to build world-class, healthcare innovations for the world, but leveraging a low-cost, high-quality, high-innovation base between India and the U.S. So our dual headquarters are Cambridge, Massachusetts, and Bangalore, India. And that duality is I think represented increasingly in many other companies. I have another company that's in the AI space that has a massive office in Bangalore and a massive office in Silicon Valley, and both are working on collaboratively AI development. And so I think there's a lot of opportunity to collaborate when it comes to talent, and then the capital flows from that. My firm, Remus Capital, has been thinking about entering India for years, and 2025 is probably the year where we're going to actually do it for all the macro reasons that we discussed earlier.
I'm curious, Christian, just broadly speaking, to get your take on your sense of how Trump's election, Trump's win, how it was greeted in India, Christian, because I've read different reports, not bad, suggesting generally it was greeted positively. But I'm curious to get your thoughts.
Yeah, you always have these great videos of people praying to the altar of Trump pre and post election in India. And that's sort of what happened. I think people are jubilant. The business community is very excited. And I think it comes down to there's a great chemistry between Trump and Modi, both of whom are expected to be the respective heads of state for at least the next 4 years. And then the second thing is I think, people expect Trump's perspective on India to be unchanged, which is positive. I think the Democrats have been more ambiguous and more mixed in their approach to India over the last decade, ever since Bill Clinton, I would say. Whereas I think the Republicans have been much more unequivocal about their embrace of the Indian country and the Indian economy and the opportunity that lies therein for American business people like myself. So, the tone and the sentiment is markedly positive in India, and I think people are excited to see what Trump brings to the table.
Christian, great to have you on the show today. Thanks for joining us. Happy holidays.
Thanks for having me. Happy holidays. Take care.
Check in on the pulse of small business. It's a busy time of year as new data shows retail sales jumped nearly 4% in the holiday shopping period from a year ago. That's according to MasterCard. But small business owners still face, we know, a host of challenges, including the tariff threat from the incoming Trump administration. Joining us now is Mark Valentino, Citizens President and Head of Business Banking. Mark, it's great to see you. So listen, small business owners, Mark, you talk to a lot of them. I'm curious, generally, Mark, when you do speak to them, how they're feeling right now. Is it positive? Is it optimistic? What's the mood like now, Mark, versus, let's say, 6 months ago, 12 months ago?
Yeah, thanks, Josh. Thanks for having me here today, and happy holidays to everybody out there. I would say the mood is actually quite positive entering 2025. If you look back over the last 12 to 18 months, small businesses have been under tremendous pressure, whether it's high interest rates, high inflation, labor markets that were frozen coming out of COVID. And I think there's a lot of optimism entering 2025 with rates having come down, inflation cooling off a little bit entering the year. And so I think overall, small business owners are really optimistic. And I would say even optimistic about the change of administration, although there's a lot of uncertainties there that are certainly presented as well.
Yeah, what has led to the optimism under the change of administration? Is it the policies that they see? I mean, we talk a lot about the tariffs that could have significant impact on small businesses. What are you hearing from them about what they're feeling hopeful about?
Yeah, well, it's a tale of two stories. Obviously, you guys have talked a lot about the tariffs, and that could be a negative headwind, certainly, if we enter a trade war with China once again. And, I don't think it's very clear whether there's a lot of rhetoric right now coming out of President-elect Trump or whether some policies are actually going to be rolled out. I think time has to tell. However, I think the potential for deregulation is actually one of the tailwinds that a lot of business owners are excited about. We saw the market kind of get ahead of that in the last few weeks, too. And I think for business owners, a little bit less regulation, possible relief on taxes being extended for several years is also positive.
Well, let's touch on taxes, Mark, because that's an interesting issue. Here's what the Ways and Means Committee said recently. They said American small businesses could be staring down our tax rate that will increase to 43.4% at the end of 2025 should Congress fail to act. I'm curious, when you're talking to small business owners, Mark, taxes, how much of that is an issue front and center they're bringing up?
Well, great question, Josh. So small business owners, basically what they take home is what they're able to provide for their families, right? And so taxes are a huge factor for small business owners, as are interest rates, as are potential tariffs. But taxes really is something that they can see very clearly in their bottom line, and it results in how much they're able to spend as consumers. And so it's a very hot topic for business owners right now. And I think there's a lot of excitement about potentially getting the tax cuts extended.
Finally, Mark, what stood out to me in your note, you talk about the tech gaps that still exist. We have heard from even major companies who've talked about a bit of a pullback in investments in technology in the face of some uncertainty economically. Does it feel like that divide is getting bigger and bigger, especially as we see sort of the major companies, retailers level up in many ways on investments in tech, especially around AI? How are small businesses able to keep up?
Yeah, well, small business owners are quite resilient over the years, as we know, and it's a huge component of our economy. I think they're going to have to just be more resourceful going forward because they can't spend, to your point, Akiko, they cannot spend what the large retailers can spend on technology and digital solutions. However, they can still participate in the digital economy. So small business owners today have probably more access than ever before in terms of creating e-commerce platforms, in terms of entering kind of digital sales markets globally, not just here in the US. And I would also say that possibly AI could be an equalizer in some of the playing field. So for example, I think it's estimated today that about 50% of small business owners are already using AI in some component, whether it's just to service customers through chatbots or other process means of improvement. And so I do think that these emerging technologies could allow smaller players to actually play bigger than they actually are in the future.
Yeah, customer service increasingly becoming a use case there. Mark Valentino, good to talk to you today. Appreciate the time.
Thank you. You as well.
Coming up, we are taking a look at the best ways to be positioned within the industrial sector with today's investor playbook. Stick around. Much more market domination still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator.
Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's been an eventful year for the industrials with AI and data centers driving energy demand going into 2025. With the new administration coming to the White House in just a few weeks, the industry could see a sizable shakeup. We're looking at which names are best positioned going into the new year and navigating how investors can play the industrial sector with the Yahoo Finance Playbook. And joining us now is Andrew Obin, Senior Industrials Analyst at Bank of America. Andrew, great to see you here on set.
Thanks for having me.
So maybe start high level, Andrew.
Sure thing.
Talk about the industrials as we flip down to 2025, a sector you know so well. Generally, Andrew, how do you feel about the space? Positive, constructive?
So we are constructive. The fundamental thesis that we're in the midst of a massive, massive CapEx cycle, right? To go back, if you look at the CapEx spending in the US from 2007 through 2019, which was the last cycle, we averaged 3% growth per year. So low single digits. Over the past 5 years, we've been averaging 7% a year. It looks like 24 was 9% a year growth, and 25 will be another high single digit growth year. So what's driving this? It's reshoring, it's investment in automation, it's inventory buildup post-COVID, but fundamentally, we do have rebuilding of the industrial base in the US, led by semiconductors, EVs, but also these industries pulling the rest of the supply chain into the US.
When you talk about the reshoring and the investments that are happening here, it's interesting to sort of, you connect the dots from the first Trump administration, and then you had COVID, and you had so many more companies saying, well, we need to bring things a little closer to home. We've been talking a lot about tariffs, but there's still several weeks to go between now and the inauguration. As an investor, how do you get ahead of a policy we're not very clear on yet?
So yeah, this is tricky. So we have highlighted long-term tariffs will probably be a positive for the US manufacturing because it will force more manufacturing to come to the US. Remember, 2018, 2019, Trump imposes tariffs on China, right? Policy, what is the policy consequence? Today, Mexico is actually the biggest, right, trade partner for the US versus China. So we've seen import shift, right? So really took 5 years, took longer than expected, but a more profound shift than people expected. What I would say is that Q1, I think, and maybe second quarter are gonna be tricky. Why? Exactly why you said, we don't know what the policy will be. When we talk to institutional investors, people seem to focus on the potential positive of the reshoring, right? Having said that, if you look at the days, right, if you look back in 2018 and 2019, when the headlines were coming out, these were not good days for the industrials. Industrial sector has underperformed on that day. Also, we're still trying to get over 50 on the PMI reading, i.e. the gauge that measures the performance of the industrial economy. So we think first quarter is going to be tricky because you could have negative headlines on tariffs, right? And we're still waiting for the inflection in the PMI. Having said that, longer term view, right, we think these headlines will be perceived as positive for the US manufacturers.
Andrew, so you're constructive on the space broadly.
Yes.
It looks like plenty of investors are too. I mean, I just look at some of the moves of some of the names in your coverage universe. Broadly, how do valuations look at this point?
Yeah, so it is interesting. So I've been doing it for 25 years plus. On an absolute basis, stocks were more expensive during COVID, but that's about it. So the stocks are expensive. However, on a relative basis, the stocks are trading roughly at a 5% premium to the S&P 500 index, which is smack in the middle of the range, particularly if you focus on the past 20 years. So they're not cheap on an absolute basis. However, relative to the market, right, they trade smack in line with a 20-year average. And I would point out, we probably have the best growth environment for industrials in the past 20 years.
We don't often make this connection between industrials and immigration per se. Sure. But I've been speaking to a number of companies who are trying to assess, well, if there is some kind of mass deportation, well, what does it mean for the labor market? What does it mean for the workforce that exists? There's a realization of the support that comes through from undocumented workers. At the same time, what I've heard consistently is automation accelerates as a result. How do you think about this?
That's exactly right. But I think it really falls into this broad CapEx cycle, right? If you step back, The real problem is when you show investors U.S. automation investment over the past 20 years, it's actually a surprisingly low number. Why? Right? Because U.S. labor markets have been very flexible, right? But also because underlying, we have not been adding new capacity in the U.S. over the past 20 years, right? So if you look, industrial assets last 20, 30 years. The last big CapEx cycle we had was back in the late 90s. So as companies think about building new factories, right? So we've made a decision not to deindustrialize. That's the focus of the government policy. Started under Trump with tariffs, right? The Biden administration, different flavor, more focus on green technology, sustainability, but actually the same policy, right? We're not going to deindustrialize. We will have a semiconductor industry. So all of this will continue. So as the companies think about building the next generation of plants, right? As people are bringing in capacity to the US, labor shortages, right? As well as the fact that we're building state-of-the-art facilities will all play, we think, in the automation in the US. The other thing, if you look at the wage inflation, right? Wage inflation in the US, pre any political changes, right, is running at 6%. I would guess it's higher than people think. It went up, never went down, right? So from that perspective, our analysis shows that automation investment tend to lag labor inflation by 2 years. So the industry is ready to invest automation no matter what. Because when we go to industry shows, right, what do we hear the companies talk? All the old folks who have the industry knowledge, they're all retiring. We have to automate the processes. So I would say all of these things were well underway before whatever political challenges are going to come.
Andrew, let's get to some tickers as well.
Sure.
GE Vernova, what a move already.
Yeah.
But you say stick with it, it's moving higher.
Yeah, it's actually a fairly simple story. Mm-hmm. The cycle is back. We're forecasting EBITDA, earnings before interest, taxes, depreciation, amortization. It's a metric that we focus a lot on Wall Street. Roughly 2.3, 2.4 billion in 2024. That number we forecast is going to go to over 8 billion by 2028. So more than triple in the next 4 years. So it means the earnings are going to grow at a compounding average growth rate of 20% plus, right? If you keep, and we're in writing saying that, if you keep the multiple that we sort of have on 26 numbers, which is 17 times EV EBITDA, we just keep pulling it forward to 2027, you have a stock approaching $600. So if our forecast for earnings growth is correct, and there are a lot of tailwinds, right? The CEO recently stated, we're probably seeing the best CapEx cycle for power generation in the US since World War II. Mm-hmm. So I'm talking about U.S. industrial CapEx, the best in 20 years. So here's a company talking about a CapEx cycle that's the best they've seen in 50 years plus, right? So that's what's driving earnings tripling over the next 4 years. And as I said, if you just assume the market roughly keeps the multiple, that's where the upside comes from.
Andrew, great to have you on set today. Thanks for stopping by.
Thank you so much.
Appreciate it.
Of course.
And while wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bells. Stay tuned for Market Domination Overtime.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, 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 it's me, Tiffany the Budgetnista, your favorite financial educator.
Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
That is the closing bell on Wall Street. And now it is market domination overtime. Let's see where the major averages ended up. A bit of a quiet day today, as we all expect on day after Christmas here. Thin trading day. The Dow ending the day up 28 points. And taking a look at the S&P 500 down, as well as the Nasdaq, although we can call it pretty flat.
I think so. All right, Akiko. No holiday hangover for the markets today, with stocks edging higher to finish this trading day. Our next guest sees the S&P 500 climbing to 6,100 to finish out the year. Joining us now is David Lott, Chief Investment Officer at Abound Financial. Dave, it's good to see you. So listen, stellar year for the market. I think few probably would have, seen the market having the kind of year it did in 2024. What do you see ahead, though, now for 2025? Do the gains continue?
Yeah, it kind of feels like we're standing up on a mountaintop, maybe even looking to the next mountaintop when you think about some of these projections that are out there. And as we go down the path towards it, I think we're going to find ourselves in the valley, stuck in the trees at some point. I wouldn't be surprised if we go sightseeing down near 5,000 before we move higher by the end of next year. When we get this type of tailwind in the market, people get a little bit relaxed, investors get a little bit lackadaisical, and instead of becoming investors, they're just stock buyers. And I think we need to make sure that we have our investment hats on going into 2025 and making sure that we're picking our spots as we put money to work.
So, David, you talk about a bit of a pullback that we could see early next year, as much as 15%. Is that kind of the healthy pullback that we need, given just how hot things have run?
Yeah, I think look at any asset, when there's a lot of demand, you're going to see that price move up pretty precipitously, and then things are going to slow down and lull a bit. I think that, it is time for things to settle. Just statistically, we see about a 15% pullback about every 2 years, 18 months to 2 years. So it's about time to see things settle out a bit. And I do believe that we're not sure what or when, but I think that there are going to be some better opportunities to buy stocks lower than they are today.
And when that opportunity comes, David, where do you see the opportunity in the equity market?
It's hard to say. I think overall we might see tech be a little bit more challenged at certain parts next year. Obviously, they've had a great run up, but they look a little bit expensive. And last couple times tech has gotten this expensive and become this big of a part of the market, then you see some opportunities follow that. That being said, it's hard to avoid being part of that earnings growth, right? Obviously within technology, within communication services. So what we're doing is kind of what you're seeing in the markets today, maybe taking a little bit of those gains, moving that downstream in the capitalization perspective, looking at small cap where you're a little bit more value oriented, and you're going to find some better valuations in financials and industrials as well. So interesting day today. I know a sleepy day in the market, but might it be a little bit of a predictor of what might happen next year?
And David, looking ahead to next year, you talked about further upside you're likely to see, even if the gains are not as significant as 2024. What are potential catalysts you're looking to?
I think that tariffs and inflation aren't going to be as bad as people think. And I think that AI and deregulation will probably be better. Kind of thinking about this a little bit as I was getting prepared. Technology is an inflation reducer, I guess, unless you're an iPhone and somehow you can just keep going up in price. But ultimately, AI, I think, is going to generate opportunities for costs to actually have a lid. And I'm starting to see that happen, whether it's less need for employees, whether it's just more efficiency. All those things, I think, lead to lower prices. And so for me, I think that some of those fears aren't going to translate into ultimately being quite as bad as people may think.
When you talk to clients, David, what's on their list of concerns? Are there certain themes that stand out when they tell you what they're worried about? Valuation, sentiment, positioning, change in administration?
All of the above. What a great question. Thank you. You know, when clients get a little bit antsy when the market's this good, right? And I just have to keep reminding them the best place for high net worth long-term investors to be, particularly if they're taking any income from their portfolio, is 75% stocks and 25% bonds long-term. So we don't want to mess with that. That being said, it is the time, if we're going to be taking money out of those portfolios, to be setting that money aside. I like to set aside 3 years worth of income needs, because you can't go into the battle and then come up with a game plan. You have to have a game plan beforehand. And for us, let's set some of that money aside in short-term bonds, and let's earn some interest, some of the best nominal yields we've seen in 30 years on that money, and not try to kind of get too tricky with it. But obviously, longer term, stocks are going to be the place to be.
So don't leave cash on the sidelines, bring it back into short-term bonds. What does the mixture look like for you when you think bonds and equities?
As I mentioned, you can't beat a 75% stock and 25% bond portfolio, which is interesting to me why 60-40 has gotten so much publicity over the last 20 or 30 years. And again, we want to make sure that we're taking money out of the stock market that we think we're going to need to access in the next 24 to 36 months. That gives us plenty of a cushion to weather any storm, but also remain invested and be investors, right? Looking at the long-term appreciation of what the markets are going to do for us, and not being so whipsawed by what happens in any 6-month period.
And David, final question overseas. You know, you look internationally, do you spot opportunities there?
Boy, it is tough to be excited about Europe right now. You know, how long have we been waiting for that valuation kind of trade to kick in, and it just hasn't happened? If anything, if we're going to play the don't fight the Fed type of idea, you got to look at China, right? Their language as it relates to helping their economy has changed pretty dramatically here lately, and they're talking more dovishly than they probably have in 20 years. So if anything, I think I would look to the emerging markets as an opportunity, but strong dollar is going to make those international earnings as they get repatriated into US dollars less attractive. And so for me, I think I'm focused on the US next year.
Some good takeaways there. David Lott, good to talk to you today. Appreciate the time.
Thank you, Akiko.
Now let's get to our call of the day. Dan Ives over at Wedbush out with a new note on the software sector. Ives highlighting Palantir and Salesforce in the note, with AI spending entering the software phase in 2025. This is about sort of the next phase beyond sort of the AI that we've been talking about. The thing that stood out to me here, Josh, Dan Ives saying specifically, Palantir has a credible path to morph into the next Oracle over the coming decade. That's a pretty strong statement here when you consider just how many companies are competing in enterprise AI.
Yeah, and it specifically calls out AIP, which is their artificial intelligence platform. He says, leading the way as many on the street continue to be huge skeptics, he says, of the Messi of AI. I'm not a soccer fan, Akiko, but I think I get the reference. Now, Palantir has roared this year. It is up around 385% in 2024. For that reason, a lot on the street have moved to the sidelines. I mean, if you just look at here, I mean, there are still 3 buys, but most of the street now on the sidelines. And when you talk to those analysts why they're on the sidelines, it's because of valuation. But not Ives. He's bullish, says this one's moving higher.
Yeah, and you know, this call in general, when you think about it, it really does point to where the opportunities are in AI. It comes down to enterprise and companies investing there. And that's where Dan Ives sees specifically opportunity for Salesforce as well. Their Agentforce platform certainly getting a big push. Mark Benioff has touted it significantly for CRM. Dan Ives says CRM is a clear second derivative beneficiary of the AI revolution. Could add as much as $80 a share to the CRM story.
It says, Nat, the time has come, Ives telling his clients, for the broader software space to get in on the AI party, Akiko?
Agentic AI.
That's it.
Something
We'll
we've
see.
heard a lot over the last few months. Well, Walmart is a winner of Yahoo Finance's 2024 Company of the Year. And for more than 6 decades, the discount megastore has redefined retail. Yahoo Finance is going beyond the ticker to take a deeper look at Walmart's biggest moments.
For more than 6 decades, the discount megastore Walmart has redefined retail. In 2023 alone, the company brought in more than $648 billion in revenue. Beyond the Ticker takes a deep dive into the company's biggest moments. Walmart was founded in 1962 by Sam Walton. Its first location was in Rogers, Arkansas. 5 years later, the Walton family owned 24 stores and had racked up $12.7 million in sales. On October 1st, 1970, Walmart went public via an IPO on the New York Stock Exchange. Shares opened at $16.50 per share. The company opened its first Sam's Club in 1983 in Oklahoma in a bid to compete with Costco's wholesale member-only model. In early 1988, founder Sam Walton stepped down as CEO, and David Glass was named his successor. That same year, the first Walmart Supercenter opened in Washington, Missouri, creating what it's currently known for, that mix of general merchandise and grocery. In 1996, Walmart opened its first location in China and surpassed $1 billion in sales for the year. Walmart.com launched in 2000, allowing U.S. customers to shop online as Amazon.com began to take off. To compete with Amazon, among other online retailers, Walmart introduced free 2-day shipping in 2017. During the pandemic, the retailer boomed as consumers sought out the COVID-19 vaccine and meant cheaper groceries as inflation picked up. In 2024, it acquired the connected TV platform Vizio in a $2.3 billion deal, and it only keeps growing from here, with more than 10,500 stores in 19 different countries.
It has been a year of steady gains for consumer staples. While the sector has lagged the broader markets, XLP is up more than 10%, with other funds seeing returns of 14 to 15%. The sector reached a new peak in September, you see right there, coming on the back of investors turning to what has traditionally been a safe haven amid political and economic uncertainty. Let's take a look at the top 5 performers. We're talking about Walmart, Costco, Philip Morris, Altria, and Colgate-Palmolive. But Walmart, really the outperformer here when you look at the performance on the year, a banner year on pace for its biggest annual share price gain since 1998. It's also the best performing Dow stock if you take out Nvidia's inclusion more recently. Walmart's gains largely on aggressive moves to stay competitive in a value-focused environment. The company cutting prices on more than 7,000 products to stay ahead of rival Target. It's also continued to expand its reach with higher income consumers. In its latest quarter, the company continued to tout market share gains with households earning more than $100,000. That group accounted for 75% of its share gains. Another stock that we are watching closely here is Costco. The retailer continuing to see big gains with cost-conscious consumers, with its membership fee revenue seeing an 8% jump in the most recent quarter. The company also made big gains in e-commerce, hitting a record 1 million deliveries in the last quarter. Finally, worth pointing out, a stock may have been overlooked a bit. Philip Morris here. Take a look at that. Year-to-date gains of nearly 30%. The tobacco maker continuing to see big gains from its smoke-free products, though. Its Zyn nicotine pouch, the biggest growth driver. Smoke-free products overall accounted for nearly 40% of its revenue in the most recent quarter. The sector as a whole, though, likely to continue seeing some tailwinds from prices coming down, despite consumers remaining cautious. But there is a big headwind that awaits, something we've been talking about a lot, potential for those Trump tariffs that could reverse some of these price decreases and ultimately gains made by these companies. Josh.
All right, Akiko. While the holiday shopping season comes to a close, the season of returns is just getting started. Retailers gearing up for an influx of return goods in January, but the issues that come with returns stretch beyond the holiday period. Here to discuss is Rebel Stork CEO Emily Hosey. Emily, it's good to see you on the show. So I imagine, Emily, this is a busy time of year for Rebel Stork, but walk us through it. What are the trends you're seeing?
Yeah, it's so nice to be on here. Thank you so much for having me. We are days away from entering what we call Returnuary, which is where the biggest part of the return season is happening. We've gone through Black Friday, Cyber Monday. We've gone now through Christmas, and we're in Hanukkah, and people are ready to make their returns. It's about an $890 billion problem, returns, which is about 17% of any company's annual sales are being returned.
Emily, I'm guilty as charged. I'm one of those that do returns, especially around this time of year. But walk us through the hit that these companies take. You just put out a number there, but what are we talking about? Is it about restocking, the cost to ship back? How does that all add up?
Yeah, so returns are problematic for most major retailers as well as brands. A lot of returns actually end up in landfills, and that's something that consumers don't necessarily realize when they're purchasing to return. That's about 9.5 billion pounds of returned product is going directly into landfill, regardless if it's used or not used. Returns are complex. Reverse logistics is complex. It's costly. The technology needed to be able to manage high volumes of returns is challenging. So most retailers, the answer has been for many decades to throw this product out, but there are solutions like Rebel Stork, where we've built the technology to be able to handle mass volumes of returns and properly quality assess them and list them back up for re-commerce so that families across North America have access to this amazing product at a fraction of the retail price.
And at Rebel Stork, Emily, you focus on baby gear, I think specifically. How come? Why focus on that vertical?
Yeah, we chose baby gear at the very beginning because 100% of baby gear returns were being dispositioned to landfill, and we saw it as just such a huge problem. Baby gear is also essentials. New families need baby gear, car seats, strollers, high chairs, and it's extremely complex due to the quality checking process that goes into processing baby gear returns. But we did just soft launch into the home categories just before Black Friday. And now on our platform, families across the United States are able to purchase home returns as well.
Emily, I'm curious how companies are starting to look at this. I've noticed just anecdotally, more and more companies are charging for returns. That wasn't always the case. That probably points to the cost hit the hit that these companies have to take. Do you find that consumers are increasingly willing to do that? I mean, it seems like a risk if you're a business that long allowed for free returns, having to charge the customers because they just can't take that hit anymore.
Yeah, I mean, I think that there's kind of two ways to look at returns. Having a really great and flexible customer-centric return policy is critical to many, many mass retailers and brands full price businesses. It does create extreme customer loyalty, as well as a very important touch point for brands to be able to interact with their customers positively. It is costly though, but there's solutions. So for example, Rebel Stork, we partner with over 2,500 brands and mass retailers processing their returns, and they're ending up making a brand new revenue stream from those returns being able to be re-commerced. So, it's not ideal returns, but it's important. It's important to be able to offer customers the ability to return for many different reasons.
I'm curious, Emily, over at Rebel Stork, who's the demo? I mean, what's the average user over there? What's your line of sight?
Yeah, so our demo primarily is expecting and new families and caregivers, but that's also because we started in the baby gear space. But as we continue to expand within other retail verticals, we see that demographic shifting. But for right now, it is expecting and new families.
Emily Hosey joining us from Rebel Stork. Good to talk to you today. Appreciate the time.
Thanks for having me.
Well, it has been a busy year for the likes of GM, Ford, and Stellantis. So what's in store for the big three automakers in 2025? Here with more, we've got Yahoo Finance's Pras Subramanian. Busy year, kind of an understatement when you think about the year these companies have had.
Yeah, I just want to say return you area. So, no, just kidding. But yes, it's a big, busy year for them. A lot happening. I mean, I'm focusing here on the big three a lot. We could talk Toyota and VW too, but for the big three in particular, starting off with GM, they had a pretty strong year. Look at shareholders are very happy with the capital returns there. A slew of EVs that have been coming out recently that have been actually well received. The big question is, will the Trump tax credits, tax credits still be here when Trump takes over in January? That's a big question for them going forward. Ford, on the flip side, doing well with hybrids, actually. Not too bad there, but they've had some warranty costs and supplier issues. Wall Street not happy with the cost sort of efficiency there. And I think their CEO Jim Farley sort of under pressure to kind of deliver and actually improve the profit picture there for them. And finally, Stellantis, just from such highs, of profit highs to really kind of suffering right now with a vacuum at the top, no CEO, that's coming 2025. Products that are building up on vehicle lots, deep price cutting, dealers unhappy. They kind of got to right that ship, but some new products coming their way, cheaper Jeep products, a new Daytona coupe in both EV and gas form, and then also some new pickups.
Now, about that, pickups, trucks, what's the outlook for 2025?
So Ford just this past year launched their new F-150. So that's been doing well and going to be ramping up, and for many years now, keep going through with that. GM also new Silverado, new Sierras out there. But we mentioned Stellantis and Ram. A Ram Charger range extending hybrid, meaning it's an EV, but it has a gas generator engine that can give about 600 miles of range. They think that will sell well. That their customers want that capability.
Do we have a price yet on that one, Pras?
We don't. I imagine the
we have a buyer here.
I mean, I'm listening. I'm listening.
I think so. The higher end trends will be very, almost 6 digits, right? Yeah. But then I think what they really got to get is a $50,000 to $60,000 work truck, higher end work truck, capability-wise, towing, that sort of thing. That'll be important for these buyers, and I think they have them with that car.
You know, there's particular focus on the big three and what the impact of any Trump policy could be. Like you talked about the EV tax credits. You know, he's talked about wanting to remove that or pull that back. There's also concerns about potential tariffs on goods coming in from Mexico too. Is there an argument to be made that they're in a stronger position because they're a little more diversified when you compare it to some of the other automakers?
Do you mean Stellantis or do you mean others?
Just when we're talking about the big three in relation to sole EV makers and whatnot. In terms of products, they're a lot more diversified. Does that put them in a stronger position when there's so much uncertainty around policy?
Yeah, I mean, in particular, Ford and GM, they still make a lot of gas-powered cars in the U.S., so that helps them a lot. I think a lot of analysts are with GM in particular, excited about the fact that they have these high-selling SUVs trucks that are made in the U.S. Now, both Ford and GM make cars in Mexico too. It's not all, but some. So I think that could be an anchor weighing on them. But for the most part, definitely for sure, the U.S. automakers that still make trucks and SUVs in this country are still going to be at least rewarded, so to speak, from Wall Street's point of view because of the fact that they're not going to be affected by any policy issues.
Let's say Trump comes in. I'm just curious to get your take on this process. And he looks at the EV market and says, you know what? Yes, we're cutting that purchase tax credit. There is that argument that that's good news for Musk because Tesla has the scale, the cost structure to weather that. What's your take on that? You buy that argument?
I mean, I think the Wall Street analysts would agree with that. They would say, yes, Tesla, they can make their cars with a almost 20% gross margin. They don't necessarily need the tax credit to move volume. They can do that already. But I mean, look, it helps. It helps people to buy a car when it's $7,000 less. For GM in particular, though, they need those EV tax credits to bring down those cheaper cars.
Finally, I know we've been talking a lot about potential merger of Honda and Nissan, and that sort of seems to point to what people have been talking about for some time. You look at sort of the middle of the road, the affordable cars, when you think about the competition coming in from some of these Chinese car makers especially, are we likely to see more consolidation? I'm not talking just about in the US, but globally, looking to 2025, because it feels like it's becoming more of an arms race.
I definitely think that is the case. We've seen people talk about that, Sergio Marchionne in the past. You need to actually bring costs together to make these cars cheaply and to take on China, which can use the government power to make cars cheaply. So yes, definitely 100%. We're going to see more mergers. I feel as though that's going to be the big story in 2025.
Praz, thank you, my friend. Appreciate it. And that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a great night.
It has been a year of records for the markets. The S&P 500 breaking 6,000, the Nasdaq topping 20,000, and the Dow closing above 40,000 for the first time. These achievements happening thanks to rallies fueled by Trump's election win, the start of the Fed's rate-cutting cycle, and of course the advancements in AI. Now, for many years, Yahoo Finance has crowned one company as Company of the Year, but this year we decided to go bigger with a suite of awards, including Comeback, Surprise, and Product of the Year. But while many companies had a chance to shine this year, there was one that shined the brightest in its field. From generating profits that outpaced the S&P 500 to its stock price outpacing key competitors, this company has become a force to be reckoned with in retail, making Walmart the pick for Yahoo Finance's Company of the Year award. I got the chance to sit down with Walmart CEO Doug McMillon to chat about their big year and the road ahead. I have told the Yahoo Finance team something has clicked at Walmart past 18 months. Something unlocked, something got unleashed. Like, what happened? Because your sales have accelerated, your profits have accelerated, and I don't see that happening at many of your competitors.
I go back to before the pandemic when I think about that and the work that we did to make some investments. We invested in wages for our associates. We invested in our people, things like education. We invested in lower prices. We invested in e-commerce. We invested in technology, all within a pretty tight period of time. That obviously creates some pressure on the bottom line, and that creates some overhang for how people think about Walmart. But if you get to the pandemic and you look at how behaviors changed, and curbside pickup, for example, grew at a much faster rate, delivery grew at a faster rate, that was work that we had already done before the pandemic that bore fruit during that period of time. And I think it caused a lot of people, customers, our associates, to recognize that we were on the right track. And we just kind of haven't looked back since then.
Every earnings report I've read from Walmart this year, maybe even a little bit last year, you're calling out upper income households, market share gains from upper income households. Why do you think you're gaining their dollars? And where do you think they're coming from?
I think, number one, we made things more convenient for everybody. Everybody wants to save money and everybody wants to save time. But it's a bit of a continuum depending on your income level. And in the recent years, we've changed enough things that make it more convenient to shop at Walmart that we've been able to retain people that make more money.
Why are prices still high for stuff?
Over the period of the pandemic, when supply chains got stretched, a number of things happened. Input costs went up, and so new levels have been reached that in some categories won't go back down. Now, general merchandise, things that are not food, has come back down much faster. In fact, we're right now in the U.S., we're deflated by about 4%. Fresh food is moving around quickly. We're just talking about eggs. Unfortunately, eggs are high right now. Some of the other categories have come down. Those cycle times are quicker. Dry grocery, consumables, kind of processed food and things like paper goods and cleaning supplies have been more stubborn, and they're much higher than they were 3 or 4 years ago. And we're obviously trying to work with our suppliers to get those prices down.
On the international business, also very, very strong year, really by country. Walmex, the Sam's businesses in China.
Yeah.
What do you attribute that to?
You've followed the company for a long time.
Back to Asda.
You've seen us, yes. Yeah. You've seen us make investments in new areas like Flipkart and PhonePe in India. You've seen us exit some other markets. So one, we're in good businesses. Number two, we have leaders in the markets that are really capable. And then some of the other things we've done, the IP that's flowing across markets now with this strategy that we have, the tech that's flowing, supply chain expertise, the work that people are doing together to make the total greater than the sum of the parts is showing up in our international results.
Do you get concerned that, some of this momentum pulls back if we have a trade war?
We want prices to be low for our customers, and we want flow to go smoothly. So when we interact with governments, all governments, we try to advocate for that consistency. In the case of the U.S., we've had tariffs in place in various forms forever, I suppose, and a batch of tariffs that happened in 2017 that we're used to operating with. So, we're positioned to manage it, but what I worry about is customers experiencing higher prices, and we're going to do everything we can to try and keep them low.
Would it be easier to make more things in the U.S.? Is that possible?
It's growing. We work really hard on that, state by state, supplier by supplier, and we're making progress. Our U.S. percentage has been going up. We've established some big goals related to that.
Is this the year that a lot of tech initiatives that you put in place, maybe when I first talked to you in 2017, that they start to unlock? Like, what are the biggest tech initiatives that have changed Walmart?
In my experience, not some sort of breakthrough year. It's just a continuum. It's just been progress, dealing with tech debt, modernizing our architecture, creating more speed on front-end applications. If you look at kind of big picture what's happened in Walmart in recent years from a customer point of view, is you still have low prices, and now you've got access to hundreds of millions of items on Walmart.com. It's not just the store assortment. Walmart's different than it was before, and you get convenience. So recent survey results have shown that customers are giving us about as much credit for convenience as they have price, and that was not the case before.
How do you think Gen AI is going to impact your business? Like, if we're having this conversation 5 years from now, what changes will I notice in the store? Or maybe things I won't notice and they'll just magically show up on your earnings day?
I'm really excited about what's happened already, and it's an energizing experience as leaders to have to learn and apply so quickly. The cycle times as it relates to generative AI are much faster than a lot of the technology, maybe all the technology that I've dealt with in my career. It's going to help us be more anticipatory for customers and members. Search is going to change. The world will look more like personal shopping assistants than it will an old-fashioned search bar with a laundry list of results that you and I then have to work through as a customer. Just saving us time, making it more convenient, helping us solve problems. In the past, if I wanted to throw a party for the college football playoffs, I was typing in soft drinks, chips, dip, whatever. Now I say, I'm throwing a party for the college football games. What do I need to know?
What does that next 10 years look like for Walmart?
Continued growth in the areas that we've already started. We probably launch some other new businesses along the way, and we keep changing everything we can to take all the stuff that people love about shopping and dial it up and invent new things related to discovery or other aspects of shopping that we love doing. And take all the things we don't like and try to get rid of them or diminish them. And technology will do that. Innovation that we as leaders and associates contribute to it will help do that. I think it's as simple as that. We're going to keep trying to make things better for customers.
Coming up, we'll reveal which legendary American company brushed off many challenges that have come its way, leaving Wall Street dumbfounded and securing its place as our surprise of the year. While there's been a lot to cheer for in 2024, the year did not come and go without its challenges. One company especially has been able to unexpectedly rise above several hurdles and race toward a strong finish. Yahoo Finance's Surprise of the Year award goes to General Motors. Here's what GM's longtime chair and CEO Mary Barra told me on the winding road for the automaker. Mary, great to get some time with you again. Congratulations on this award. We appreciate you joining Yahoo Finance. I know it's been a busy time. My first question to you here is, as an executive in the trenches all year, Does your performance this year feel like a surprise to you?
Well, I think I'm so proud of the team at General Motors. They've all worked so hard to be able to deliver the strong performance as well as great vehicles. It's all fueled by vehicles we've been working on for a couple of years. We have the strongest internal combustion engine portfolio we've had in a long time. And this, what for General Motors, was the year of EVs. The portfolio of EVs that we have that cover the different segments from luxury to value, it really has given consumers choice between ICE and EV. And I think that's what's fueling our profitability. And people are starting to say, look and say they understand that this is a company that is differentiating itself in the industry.
What surprised you about the business as the year has gone on?
Well, I mean, there's been a lot of change. We're an industry in transformation, and GM itself is in the midst of making sure we're ready and proactive for the changes that are coming. But I think what was a pleasant surprise to me, I don't know if I'd call it a surprise, but I really felt validation for the team on how well received each of our EVs were.
You know, as you look back over the past few months, is there something that you would have liked to move faster with and that you're really focused on for next year?
Well, I think this year was really, again, getting the EVs out there to get to scale, because scale is going to be so important to drive to profitability. So next year, we'll continue to build on that, hitting more milestones of how we improve the profitability of our EVs. I think also we made some difficult decisions this year to set the business up for success, because we're trying to really be proactive and look at where is the business going. So the restructuring that we did in China and the pivot that we did to cruise, make no mistake, we are still 100% committed to autonomy, but we recognize there's quite a bit of capital that needs to be deployed into the rideshare business, and we want to deploy and work toward improving Super Cruise, getting to L3, L3 plus on our journey to L4.
You have Tesla wanting to drop robo-taxis, you now integrating your technology, Super Cruise technology into your vehicles. Are you not a believer in robo-taxi? And it's not just a Tesla thing. We've heard also Uber, may want to have interest in this.
Well, I think robo-taxis are going to be important to get to really, I'll call it rideshare 2.0. We just looked at it, and operating a fleet of vehicles and all of the associated services and operations that are needed to do that is not our core business. We sell beautifully designed vehicles to consumers and to fleets, and they love technology. I mean, the feedback we get on Super Cruise is when people experience it, they say, 80% of them say, I wouldn't want to buy a car without it. And so as we looked at those insights and we looked at how we could accelerate our work in driver assistance technology, getting to L4 autonomy, we thought it was a faster path, a more focused path. And, our plan is to bring the two teams together, and between the expertise that we've brought into General Motors and the tremendous expertise that Cruise has, we think we can move faster and differentiate ourselves in this space as well.
You put a real flag in the ground many years ago, Mary, said we're going to be making all electric vehicles by 2035. Is that still your North Star and your hope?
Well, we still have a plan that allows us to get there, and so we're still executing to that plan. But the most important thing, and I've been saying this for a couple of years now, is we're going to be guided by the consumer. We want to give the consumer choice. What do they want to drive? We don't want to get into a situation where regulations are driving us to force something into the market that's not what they want. But I think once people start to drive an EV, they realize it's instant torque, beautifully designed. At least General Motors vehicles really give them a lot of technology in the right segments. And then not having to go to the gas station and the benefits of EVs, I think, is something that people are going to move to because it's a better product. What we need to do to accomplish that, though, is to have a robust charging network. And that's what GM Energy is working on with a number of partners.
Mary, I was just talking to the CEO of an apparel maker, and she was making the point, if we get tariffs, I could take what I make and move it to another country. But you can't do that in the auto business. I mean, you can't erect a new factory overnight or within 6 months. I mean, these are big buildings with machines, and you do make things in Mexico and Canada. I mean, how fast can you react if we get hit with tariffs?
Well, it depends on the product line of where we have production, because in some cases we have production in multiple plants. But I think what we want to make sure is people understand what the implications are and what it means to the U.S. economy from a jobs perspective, from a pricing perspective for consumers. So we're going to continue to communicate with all of the governments, and hopefully we'll get to a good decision. But either way, we're proactively looking and considering all the options that we have, so we'll adjust as appropriate.
Now, we can't look back on 2024 without talking about market darling Nvidia. The chipmaker continued its dominance from last year and is looking to stay ahead of the competition with its next generation AI chips, making Blackwell Yahoo Finance's choice for product of the year. Julie Hyman explains what makes Blackwell a cut above the rest.
Julie, I know you've done some amazing reporting on why this chip is so beloved.
Yeah, I mean, I will mention one of the ironies of this being picked as the product of the year. The thing didn't ship till the fourth quarter, right? But there has been such anticipation and such demand from the hyperscalers to get it to power their data centers and their large language models that's why we named it the product of the year. So if you look at some of the specs on this chip, and listen, I am not necessarily a semiconductor expert, but the numbers sort of tell the story here. So it has 208 billion transistors. That is more than 2.5 times that of Hopper, which was the predecessor chips. And then there's something that NVIDIA talks a lot about, and other chip makers too, which is the so-called total cost of ownership. Blackwell is expensive. It is the most advanced and therefore the most expensive GPU on the market. However, NVIDIA argues that because it is highly energy efficient, the total cost of ownership over the lifetime of the chip makes more sense. And then it's not just Blackwell that NVIDIA is selling, it's really a whole computing system. So it combines with the Grace CPU for a full rack of computing power. That's what's going into these data centers. Now, CEO Jensen Huang, he rolled this out. He first introduced this in March. And here's what he said about Blackwell at the time.
There's no memory locality issues, no cache issues. It's just one giant chip. And so when we were told that Blackwell's ambitions were beyond the limits of physics, the engineer said, so what? And so this is what happened. And so this is the Blackwell chip.
So it's showing there the physical chip. It is the largest GPU ever made as well, we should mention. And it's made by using two die, basically two chips that are connected by a high bandwidth interface. That was one of the leaps, the innovation leaps that NVIDIA made in developing the chip. You can see what it's already done. Well, if you look at the revenue growth that we've seen for NVIDIA already, as I said, Blackwell didn't actually ship till the fourth quarter of the year. So a lot of this is demand for other data center chips like Hopper, what we've seen thus far. But the real surprise began for NVIDIA, not this year, but last May when we had that big upside surprise in revenue. And then the company's revenue has just continued to grow here, although at a somewhat slower rate, the bigger it has gotten, Maddie.
What are your sources telling you just about the path forward for NVIDIA and whether Blackwell will be enough to keep NVIDIA as the leader?
So let's be clear here. NVIDIA is still absolutely dominant in this space. When I talk to analysts, I talk to Ben Beheron, I talk to John Vinn over at KeyBank, and they talk about 80% plus of the control that NVIDIA currently has on this data center generative AI LLM market, right? So they are hugely dominant. And when you look through the next year, Vin said, as long as they can solve some of their manufacturing bottlenecks that they have had and get the flywheel going, then they'll be fine. Yes, the revenue growth is expected to slow, but again, that's because they're coming from higher and higher numbers, and demand doesn't seem to be of a concern. The competitive threat is going to come from custom chips, most likely. AMD, yes, but Broadcom, as we've been increasingly talking about, got a lot of attention in its most recent report, talking about the increase in demand for custom chips. But again, when I talked to analysts, they said the custom chips aren't there yet. They are not yet competitive. They're going to chip away, they're going to increase, and at some point maybe they will be there. But if you look over the next year, doesn't seem like that is yet happening. You have to maybe look further out to see the changes that are perhaps going to come.
AI has certainly been a top theme of 2024, but so has one asset class, crypto. And in that space comes our pick for comeback of the year. Find out who it is on the other side. Crypto making a grand return to the spotlight in 2024, with Bitcoin topping $100,000 for the very first time. But which names stood out to win Yahoo Finance's comeback of the year? Well, that honor goes to Robinhood, as the company became consistently profitable while delivering a host of new products for investors. Here's what co-founder and CEO Vlad Tenev had to share with me on the company's comeback journey.
I think for people to understand what has happened to your business, we have to go back to some of those like lower points in the business for you, for as a leader in a business. I mean, what were those like, and how'd you get out of them?
I think 2022 was challenging, and 2021 when we went public actually had some stress as well. I remember when we entered the public markets. I mean, it was sort of at the height of the secular bull market, and we felt good, but the business now is much stronger across pretty much all dimensions. We have 9 business lines that are generating over 100 million in annual revenue. Business very diversified, growing across our main priorities of active trading, growing wallet share for the next generation.
Big year for the company stock price, big year for your company financially. This could be a really different company 10 years from now. Like, what is your vision for Robinhood?
I think the vision really is for anyone, anywhere in the world, whether you're an individual retail investor or an institution, Robinhood should be the best place for you to custody all of your financial assets and process all of your financial transactions. And so it's expanding across the 2 dimensions I mentioned earlier, going global, where we've got lots of winds blowing. The rest of the world is getting wealthier. It's going to the technological frontier. Mobile penetration continues to go up. Internet is becoming ubiquitous. There's multiple trends that are moving towards more self-directed, more focus on U.S. products and U.S. markets, and AI and cryptocurrency sort of booming at the same time. And Robinhood can really be at the center of these things, and I think those are going to be the growth drivers in the financial industry over the next 10 years.
How happy are you that Gary Gensler's out the door, and we have potentially this guy, Paul Atkins, who sure seems bullish or more bullish on crypto than Gensler?
Yeah, I mean, I think that Paul Atkins, we're very excited about him taking on the mantle and getting the agency pointed in the right direction again. I think the American public wants to know that regulation is here and that they have standard protections. There's good reasons for regulation in the first place. You want to avoid all the downsides and all the hard lessons we learned in the traditional financial markets that led to it in the first place. And we're very optimistic about that. And we're also looking forward to the end of the regulation by enforcement approach that has been bad for the industry, frankly, and bad for the public in the U.S.
If investors are trying to make sense of this move in Bitcoin and other cryptos, what do you think happens in the first year? What's the biggest unlock that you would like to see in the crypto industry from this administration?
Well, I think there will be a push for comprehensive crypto legislation. There's a stablecoin bill that got battered around a little bit, never made it to the Senate. That will probably be reproposed, maybe in a slightly different form. So there's talk of a Bitcoin strategic reserve, and I think if that happens,
what does that do to a business like Robinhood?
Well, we've been early to crypto, and we're one of the few public companies that actually has a large crypto business associated with it. So as the industry grows, I think Robinhood is well positioned to benefit from that.
When you look at the company, like how you made some comments on sports betting. I was trying to figure a way to ask it, but do you want to be that broad? I mean, are you going to go toe-to-toe with Yahoo Sports? I mean, what's your ambitions? Clarify that stuff for us.
I think that was taken a bit out of context. There was a question about the election product we rolled out. So we're going to broaden that. We're going to have a more expansive regulated events offering, and these are CFTC derivatives, so federally regulated. There's all kinds of contracts and events that are permissible that we'd want to allow people to trade.
Do you have ambitions that or view that you want Robinhood to be this generation's JP Morgan?
Well, one of the things we care about, this is the second arc, our 5-year arc, what we call it, to be the leader in wallet share for the next generation. And right now, Robinhood has more millennial and Gen Z customers than the leading
50%
brokerages.
millennials?
Your millennial penetration and Gen Z is even higher, actually. So we see an opportunity to help them with all of their financial needs with an emphasis on multi-generational needs. So we want to serve their parents, their kids, and I think that's something that the existing industry players don't get right. Nobody has a great kind of like family, multi-generational experience. And I think there's low-hanging fruit there. If we serve the whole family and really have a great integrated experience, which our recent acquisition of Trade PMR should help facilitate, I think Robinhood can be the place where, you actually like stick with.
That's a wrap on Yahoo Finance's 2024 awards. Thank you for watching.